All right, welcome back, students who are taking financial accounting. In this series of videos, we were working on the assigned homework problems from the digital study guide for Chapter 7. The problems for Group B. A note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And so we are now working on problem 7-53, and this is accounting for the notes receivable. All right, so it says Oklahoma City Insurance received the following notes during 2014. So these are it. Number 1, identify each note by number. Compute the total interest on each note over the note term using a 360 day year, ordinary interest, and determine the due date and maturity value of each note. Round the interest calculations to the nearest dollar. All right, so number 1, let's see if this here is the year 2014, and the date is November 5th, right? And the term is 1 year. So the due date is going to be November 5th, 2015, all right? The principal is, so that's the due date, maturity value, all right? And we're going to round interest calculations to the nearest dollar. Okay, so we have principal of 20,000, and we're going to calculate the interest. We take the 20,000. All right, remember, principal plus interest is equal to maturity value. Okay, so our interest is 20,000. It's at 9%, and it's for 1 year. So 20,000 times 0.09 times 1, 9, so that's $1,800 of interest. Means we have a maturity value of $21,800. Okay, that's number 1. Right, number 2, so that's November 30th, and it's for 9 months. So November, December, January, February, March, April, May, June, July, August. All right, now pay attention to the date here. Okay, remember November 30th. All right, so all of December is 1 month. January, February, March, April, May, June, July, August. So the due date is August has, that's 9 months. So that would be August 30th, 2015. Because remember, these dates are 2014 here. All right. So our principal is 6,000 plus, let's calculate our interest, 6,000 times 0.113% times 9 over 12, right? 9 months over 12, right? So 6,000 times 0.13 times 9 is equal to 7020, and that's over 12, right? So the 7020 over 12, and that's equal to, let me erase that there, and that is equal to, divided by 12, that's 585. So that's $585 in interest. So the principal is maturity value is $6,585. All right. Now, number 3, December 7th for 60 days. Right? So December has 31 days. January has 31 days. To visualize this, all right, draw yourself a timeline. Right? This here is 12/7. This is 12/31, 1/31, and then this is 2/28. But we only need to go to 60 days, right? So between 12/7 and 12/31 is 24 days, plus 31 is 55, because there's 31 days in between here for the month of January. So we only need 5 more days. So because it's a 60-day note, less 55 days means we have 5 days in February. So it would be 2/5/2015 would be our due date. Okay, use the timeline in order to be able to more visually see that. Okay, if you're just going to go and say, okay, 60 days is 2 months, and you make it 2/7, you're wrong, because you know, like I said, December has 31 days, and January has 31 days. Now, me personally, I probably would have said, okay, from 12/7, and this is just a different way of thinking about it. Use the timeline, all right, to be able to more visually see. Pull out a calendar and more visually see. But me mentally, in my mind, I said, okay, I'm on 12/7, 7, and there's 31 days in December and 31 days in January. Well, that's one extra day if I'm assuming 30-day months, okay? So if I went 60 days, would take me to 2/7, but because I have this one extra day at the end of January and at the end of February, I would take 2 away from the 7 and would make it February 5th, all right? Because I'm just saying, okay, every month has an average of 30 days. So if I treat every month as 30 days, well, these 2 months have one extra day, which means I have to take off those extra days from that due date, all right? But that's just the way I think about it. All right, so 12,000 plus, so 12,000 times 11% times 60 over 360 is equal to 12,000 times 0.11 times 60 gives me 79,200 divided by 360 gives me interest of 220. So it's 220, and my maturity value is $12,220. Okay, so that's number 1. Right. 2, journalize a single adjusting entry on December 31st to record accrued interest revenue on all 3 notes. Round interest calculations to the nearest dollar, and explanations are not needed. Okay, so let me erase this. All right, here we go. All right, so for number 1, what I'm doing is I'm going to make a journal entry, a single entry, as of December 31st. Now notice that all of these notes come after 31st, so I'm just recording the interest up to that point in time. All right. So for number 1, I have 20,000 times my interest rate of 0.09, but the note started on November 5th, and I'm going to December 31st. Okay. So how many days is that? That's 56 days. and I'm dividing that by 360. Right? So 20,000 times 0.09 times 56 days is 100,800 over 360. So I divide by 360, and that gives me $280 in interest up to December 31st for note number 1. For note number 2, I have 6,000 times 0.13. All right, so the number of days for the second note, all right, since this is 1130, to get to 1231, that's 31 days over 360. So 6,000 times 0.13 times 31 is 24,180 over 360. Divided by 360 gives me 67.1666, but remember we're rounding, so it's 67. And again, if you're not sure how I arrived at the 56 days or this 31 days, or in this next case here, I'm going to be looking at 24 days, right? Draw yourself a timeline and work it out, or look at the calendar and calculate exactly how many days. Okay, and so now I have 12,000 times 0.11 times 24 days over 360. Right? 24 days because December 7th from December 31st is 24 days. Do the math. Times 0.11 times 24 is 31,680 over 360. Divide by 360, and that gives me $88 in interest. Okay, so I need to make a journal entry because it says here, journalize a single adjusting journal entry for this accrued interest. So I have 280 plus 67 plus 88 gives me a total of $435 in interest. So my 1231 journal entry would be a debit to interest receivable for $435 and a credit to interest revenue for $435. Okay, so that would be my journal entry. Now remember, this here, the notes occurred on these dates, and they're not due until these dates. But at the end of every accounting period, you've earned interest, right? So even though it hasn't been paid to you yet, because you're not going to get paid until these dates, you've earned that interest, and so you need to put that on your books. And since you're earning the interest, obviously that's revenue, and you would have a general ledger account called interest revenue. But since it's owed to you, all right, you're going to treat it as a receivable, and you would have an interest receivable account. And that interest receivable account most likely would be in your accounts receivable subsidiary ledger, all right? Or if you had a separate interest receivable account, like in this case here, we would actually have a general ledger account called interest receivable, and you could put it directly to that. But most often, instead of having this interest receivable, it would instead you would act, like I said, you would have an accounts receivable account, and you would put it to the accounts receivable, and one of the subsidiary ledger accounts would be the interest receivable account. All right. And you'd keep track of it that way, okay? Because you're talking about having 3 different companies that would owe you the money, and it's easier to keep track of the three different companies as if they were accounts receivable. So in your accounts receivable subsidiary ledger account, you'd have interest receivable, ABC company, interest receivable, TUV company, and interest receivable XYZ, right? Whereas if you lump them, if you only use the interest receivable account, now you actually have to be going into that account, and that information, especially over a long period of time, can easily get all jumbled, and you have to be going back and have to be trying to figure out what amounts and so on and so forth. Obviously, explanations as part of your, or descriptions as part of your journal entries would help in being able to determine the terms and the amounts, but in the real world, it just makes more sense to use an accounts receivable and keeping an interest receivable in the subsidiary ledger for each individual account, and treat it just like it's an accounts receivable. Okay, and so when the business goes and pays and collects on it, okay, you would, like we're going to do for this next entry. And for that, I have to erase some of this. And you would offset the interest receivable, right? But you want to make sure that it's it's accurate. So it oftentimes, by having the separate accounts receivable, subsidiary ledger accounts, you keep track of it better. You'll see what I mean in just a second here. So for number 3, it says, journalize the collection of principal and interest at maturity. Explanations are not required. Okay, so, and this is for note number 1. All right, so we're only looking at this note here. So on 11/15/2015, okay, they're going to pay off their note. Okay, so how much in interest did we were what's the maturity value? Well, the maturity value here is 21,800. Right, so we're going to debit our cash for 21,800. We're going to credit, all right, debits have to equal credits. We're going to credit our note receivable, which we would have made as our original entry when we first lent the money. So that was 20,000. So that'll reduce that note receivable to 0. Our interest receivable would be for that month $280. Okay, and that's you get by taking 20,000 times the 9% times the number of days. Let me think about this here, because I'm not agreeing with the answer. Let me think about this. The book is showing 56 days over 360 as our interest calculation to get 280, right? And to get the 280 right here. And that's not 15, that's 5. Sorry about this. I'm just gonna give you the answer, but then I'm going to make a correction here. All right, and then of course our interest receivable, our interest revenue. I see what they did. Okay, no, that's right. That's going to be right. And so our interest revenue would be the 20,000 times 9% times 304 over 360, which ends up being 1520. Okay, so that would be our journal entry. And the reason why this is right, because what I'm seeing here and I'm thinking through the process, is that we made a single journal entry on December 31st, okay? And that's the 56 days, all right? But the term is 1 year, all right? So there's a remaining 304. 304 plus 56 is 360 days, or the 1 year, okay? So what they did is they're saying, okay, for this journal entry, we ended up making these here journal entries on December 31st of 2014. But from 12/31/2014, we didn't make any journal entries until we paid off this note on 11/5/2015, all right? So knowing that, yes, our interest receivable of 280, right, which was part of the entry we made for number 2, we're reducing that to 0 because it's being paid off. But we have to record the interest revenue for the entire period from 1/1/2015 all the way to 11/5/2015, and that's 304 days, okay, using a 360-day method. Using the ordinary method of 360 days. And so we have to record the interest revenue, which ends up being 1520 for that period of time. Okay, so that's, that journal entry is correct in the solution manual because of the way the problem ends up being worked out. Now, I had said that instead of having the interest receivable, which they're only having one account, okay, I might have made that to my accounts receivable, and let's just call it XYZ company, okay, and then this way I'm affecting my accounts receivable, and then I would also be making the reduction of the interest receivable in the accounts receivable subsidiary ledger account called interest receivable XYZ company, okay, because that's only 280 of the 435, okay, and we're talking about, we would have already made entries for number 2 and for number 3. Now granted, we would only have $280 left in that account, but if we do this on a consistent basis and we're only using just an interest receivable account, now I actually have to go back into that account and reconcile it, all right? Even though I can do the math to come up with the numbers, I still need to reconcile it with the general ledger account in order to make sure that it's accurate. Well, it makes more sense to do all of the math first and say, okay, this is what my interest receivable is for this company, this company, this company. So now when they go to pay it off, I don't have to go back and redo the math and reconcile an interest receivable account. I can just look at the accounts receivable account called interest receivable, whatever the name of that company is, and say, oh yeah, my interest is $280. Oh, that's what that receivable is, $280, and I'm good to go. Right? If you're using the interest receivable general ledger account, yeah, your calculation is 280, but if you're doing this on a consistent basis where you have a number of receivables in there, you don't know if you've made an error or not, right? So you have to reconcile that account to make sure that it's accurate, and you're doing that every time. So I have a tendency not to use interest receivable. I have a tendency to use accounts receivable. I mean, both ways work. There's, don't misunderstand me. I mean, they're both, technically correct. It's just a matter of what's more efficient and makes more sense in the real world. Okay. I mean, if you've got, think along the lines of banks. They're not using separate interest receivable asset accounts. All right. That's like saying, okay, I have an accounts receivable. I don't want accounts receivable Betty Jones, accounts receivable John Doe, accounts receivable, James Smith, and have, 50 accounts receivable accounts. No, you have one general ledger account called accounts receivable, and you create the subsidiary ledger. Yes, you could create an interest receivable account and have an interest receivable subsidiary ledger if you had that many accounts, and that's another way to go. But if you only have 2 or 3, or 5 or 6, whatever, you might not want to create the interest receivable account and keep a separate interest receivable subsidiary ledger. All right. Instead, you would just use the accounts receivable account and have the interest receivable as subsidiary as part of the subsidiary ledger of the accounts receivable. And it's just a matter of efficiency and expediency. Obviously, if you outgrow the account, where you have a lot of accounts and you outgrow accounts receivable, then you would think about having an interest receivable account and having the subsidiary ledger accounts for it. Okay, um, but that's sort of that explanation. And if you have any other questions, pause, rewatch this video again, and then, if you still don't understand something, feel free to contact an instructor. Okay.